Vale, pues buenos días a todos. ¿Se oye? Bueno, tengo el placer de presentar al profesor Renatas, que viene de la Universidad de Portsmouth, en Reino Unido. Y bueno, Renatas es un viejo amigo porque nos conocimos haciendo el doctorado, lo hicimos juntos, o parte del doctorado lo hicimos juntos, cuando estudiamos en Alicante. Y luego pues él ha tenido una trayectoria muy diferente a la mía porque ha viajado mucho. Creo que estuvo en México unos años, estuvo en Alemania, estuvo en Reino Unido. Él es lituano de origen, pero bueno, en realidad es una persona muy de mundo, como veis. Y bueno, pues ahora también ha sido muchos años consultor de la Universidad Oberta de Cataluña. De hecho creo que sigue como consultor activo. Y bueno, actualmente está trabajando en temas de finanzas, se dedicó más al mundo de las finanzas y esas cosas. Y bueno, está haciendo ahora con nosotros una estada de 3 semanas aquí en IN3 y estamos empezando a trabajar unos temas donde pensamos que se puede combinar su conocimiento de finanzas con lo que aquí hemos trabajado de temas de optimización, metaheurísticas, etc. Entonces, Renatas, gracias por tu estancia aquí y si nos quieres presentar tu trabajo.
Okay, so first of all, thank you very much, and I would like to thank the Institute for hosting me and for giving this opportunity, to stay with you guys over the last 3 weeks. Yeah, so it has been very nice. Yeah. Now, my research area is finance and macrofinance. Yeah. Now, as Angel also mentioned, so I'm also going multidisciplinary. Yeah? So currently we are using meta-heuristics to portfolio optimization. Yeah? But the research that I'm planning to present today is slightly different. This is what I have done so far. Before coming to Barcelona, to this institute. Yeah? So this is about government interventions, banks, and credit default swaps, basically. And this is co-authored with my colleagues at Portsmouth Business School, Nikos Paltalidis and Konstantinos Vergos, 2 Greek guys. And we have many Greeks in our department. Yeah? Okay, so basically. Let me also present the contents of my presentation. So first of all, I will introduce you guys to my research. I will provide the background and definitions for the credit default swap market. I will formulate the hypothesis of our research. I will outline our contributions. I will then formulate the methodology, which is based on Markov-switching vector autoregressive model. Then I will describe the data, will provide estimation results, and then I'll basically summarize our findings in the conclusions. And then basically I will justify myself why I am here, basically. So that's where I will introduce basically the ideas that Angel and myself put forward, in our joint research. Okay. So now, this research basically refers to the Eurozone, so that's why here I have the Euro image. Okay? And by the way, if you have any questions or queries, so feel free to interrupt me and ask me, okay? Okay, so basically, now, probably most of you heard about credit default swaps. I will basically introduce to these concepts in a couple of slides. It was growing importance of these derivatives after the global financial crisis, so after September of 2008. And precisely in September 2008 was the collapse, it was marked by the collapse of the Lehman Brothers bank. And that collapse was followed by basically unprecedented deterioration of public finances. Yeah. So now, after that global financial crisis, there were several further crises in the Eurozone. And those crises were mainly sovereign debt crisis, in the southern part of the European Union, so mainly in Greece, Italy, Portugal, Spain, and also Ireland. So in these countries, basically, the sovereign debt markets saw heightened turbulence. Okay? So what happened is that the sovereign debt crisis caused sovereign credit default swaps rise sharply. So this means that the risk, the premium, the default premium rose in those countries. Why? Because there was higher perceived probability to default by those countries on their debt. Okay? And basically, this major collapse of large banks also triggered a response of the euro area governments. Yeah? So what the governments did, so they provided a large rescue packages to basically troubled banks. Okay? And some governments also took over the liabilities from those troubled banks, so they became, in fact, effectively the part owners of those troubled banks. Most of those packages were provided just after the collapse of the Lehman Brothers in October and November of 2008. Yeah? So as you will see later on, basically the credit default swap spread in the market, sovereign and banking sectors, they moved in unison after, well, before and after the global financial crisis. Okay? But after basically numerous euro area government interventions, basically there was a period when basically there was divergence between the two variables, the credit default spread in the banking sector and in the sovereign market. So that was partly due to the interventions by the euro area governments. Okay? So this was because the credit default risk was effectively transferred to the public sector. Okay? Now, let's talk about the credit default swaps market. So let me provide, first of all, the background for the credit default swaps. So they first emerged actually 20 years ago now, when JP Morgan basically created these securities, and these securities basically were to insure against the risk of different basically debt instruments in the market. So those debt instruments could be, loans, bonds, or asset-backed securities. Okay? So they came up with a single name, the so-called single name credit default swaps. And by the beginning of the global financial crisis, basically the Wall Street manufactured trillions of dollars worth of the swaps. So this was really, very active and very large market. Okay, so the data, basically this information was taken from Financial Times. Okay, so now what is credit default swap? So first of all, this is a derivative contract, yeah? And it allows investors in an underlying debt instrument to protect themselves against deterioration of credit quality or even a default on debt by companies, banks, and the governments. Yeah, so basically, this is like an insurance, basically. So if you buy, for instance, a bond, and you think that there is a positive probability that the issuer of the bond may default in the future, so you can additionally also buy a credit default swaps, which provides you an insurance, basically. So if, for instance, the issuer, that might be a government, defaults, so the seller of the credit default swap will pay you basically the face value of the bond and basically any outstanding interest payments. Okay? But in addition to this, and that's the main difference between the insurance and this derivative, is that you can also speculate basically by buying the so-called naked basically credit default swaps as basically an independent financial instruments. Yeah, so you can speculate, for instance, against the financial health of those entities, that basically have issued debt instruments. Okay, so the buyer of the production makes periodic payments to the seller. So this is the so-called basically the default premium, which is expressed in the basis points, and receives a payoff in the event of a default or any other credit event specified in the credit default swap contract. Okay, so there are different events basically that qualify you basically to receive the money, the payments from basically the seller of the credit default swaps. Now, regarding the so-called naked credit default swaps that I used to speculate. So recently, by recently I mean it was in April of 2013, it was a ban by the European Union, by European Commission, on using those credit default swaps for speculation. So this was basically to reduce the volatility in the credit default swap market and to ensure that basically these instruments are used to insure against the default of debt instruments. So basically, as you have seen, basically, so I have talked about basically two agents in this economy. So agent number one basically is the banking sector. Yeah, agent number two is the government. So what we study here, among many other things, is the relation between the credit default swap spread in the banking sector and in the sovereign market. Okay, so well, I will only present a subset of our results, basically. So we formulate two hypotheses. Hypothesis number one is that a systemic banking crisis gives rise to a business cycle recession, and this recession weakens public finances, basically, so the government receives less of income in the budget, and therefore credit default risk is transferred from the private, from the banking sector to the public sector. Yeah, so this means that when there is a perceived increase in the perceived probability to default by banks, yeah, so credit default swap spreads increase in the banking sector, but also credit default swap spread in the sovereign debt sector, they also increase. Yeah, so that's hypothesis number one. Yeah, but we also formulate the so-called feedback hypothesis. So there is also a feedback effect from the sovereign sector to the banking sector. Yeah, so the sovereign credit default risk is further transmitted to holders of sovereign debt, but this means that now there is a higher risk premium, yeah, on investing in the sovereign bond market, yeah, okay, and because the banks, they hold, among their assets also the government debt, so therefore higher risk premium is also required on investment, in the bonds of banks. Okay, so the feedback hypothesis implies that when there is an increase, for instance, in the credit default swap spread in the sovereign that sector. So that leads to an increase, in credit default swap spread in the banking sector. Okay. Okay, so basically now, how do we contribute to the literature? So we have various contributions, basically. So we follow the literature that studies the regime-dependent determinants of the credit default swap spread. And we contribute basically by formulating a multiple equation model that allows also for changes in regime. So basically, the existing literature focuses mainly on single equation models, regime-dependent single equation models, or multiple equation models, but in single regimes. So what we do basically here, we combine the two strands of the literature, and basically we then design Markov-switching multiple equation models. And we use a novel Markov-switching VAR, Markov-switching vector autoregression model. And this model relaxes the assumption in the previous research that stock market variables are exogenous in determining credit default swap spreads. So in addition to variables from the credit default swap market, we also have here stock market variables such as the stock market index and the volatility index. Okay? And actually, this model allows computing the so-called regime-dependent impulse response function. So basically, this means that if you have like different regimes in the market, well, in our context, regimes are determined by the residual volatility in the credit default swap market. So we identified 3 regimes. So this means that there will be a different regime-dependent impulse response function. So if there is an impulse, for instance, in credit default swap market, so it will be transmitted, to other markets, and other variables. Okay. And basically, we contribute to the literature as well that studies the effects of rescue packages, as I mentioned previously, provided by euro area governments to the national banking sectors, on credit default swap spreads. So basically, remember I formulated 2 hypotheses, so I can already advance my findings. So we provide evidence supporting the hypothesis number 1, that government interventions in the banking sector led to credit risk transfer from the banking to the public sector. And also, our results support the hypothesis number 2. So the hypothesis that formulates the feedback effect. Okay. Now, let me shortly introduce, Markov-switching vector autoregressive model, basically. So we have YT. So YT is a vector of different endogenous variables, the variables that actually react to any influence in the market. Okay. Later on, I will introduce, I will describe the endogenous variables. X here and here is a vector of exogenous variables, So exogenous variables here, they do not react to any other influences in the market. So we assume that the interest rates are exogenous variables, So basically, and we also have here different regimes, So in the general form of the model, we assume that we may have M regimes in the market that may be basically identified using different means. So here I use residual volatility to identify 3 regimes. Okay, so basically, and I use basically I assume that my vector of endogenous variables that includes the credit default swap spread, the stock market index and the volatility index, basically they respond to the lagged values of, the same variables and also to the contemporaneous exogenous contemporaneous values of the exogenous variables. Okay. And like I mentioned, basically because I have this Markov-switching VAR, that allows regime dependence, so we can also formulate the so-called impulse response function. So now the impulse response function shows how the level of the variables changes over time in response to a shock in the current period. So for instance, if there is an unexpected change in the credit default swap market now, basically, so the impulse response function is show how basically the variables in the model, the endogenous variables in the model, basically will react to this change over time, from the current period to, well, any finite period in the future. And basically here, I basically use, small twist, basically. Instead of using the basically Cholesky decomposition-based impulse response function, so basically the Cholesky decomposition is a way to decompose the residuals from the model such that meaning, the economic or financial meaning is provided basically to the shocks. Yeah. So rather than using Cholesky decomposition, I use the generalized impulse response function, which is more flexible, and the generalized impulse response function does not require an arbitrary ordering of the variables in the VAR, because basically the Cholesky decomposition implies that the ordering of the variables in the vector autoregression model matters. Okay, now we estimate this model using Bayesian econometric techniques. We're using a Gibbs sampler, basically. So the Gibbs sampler assumes, or in general, the Bayesian econometric techniques assume that basically these coefficients, C's and B's and G's and A's, basically, they are not constant as traditional econometric methods assume, but they are variables, yeah, so that requires some sort of simulation, yeah. So now the advantage of the Gibbs sampler is that it does not have to simulate basically the let's say joint distributions, but it's basically it suffices to simulate just marginal distributions, okay, and also. The Gibbs sampler is actually a stochastic version of the expectations maximization algorithm used by traditional econometric methods. Okay. So let me now describe the data. I apologize for my voice. I still have some bugs. Okay, so. We use daily data here in our study from March of 2005. So we have some sample subperiod before the subprime mortgage crisis and before the global financial crisis. And this spans to June of 2013. The data extracted from the Thomson data stream database. Yeah. So like I mentioned, we have 4 endogenous variables. Yeah? So we have sovereign credit default swap spread and the banking sector sovereign credit default swap spread. Yeah. Now, these derivatives, basically, they are measured as index points. Why index points? Because basically they combine single name credit default swap spread from a number of European countries. Yeah. So basically this is like a portfolio of credit default swap spread in Europe from different countries. And by the same token, basically, the banking sector credit default swap spread provides a portfolio, basically, of credit default swap spread from the banking sector. In addition to the credit market, we have also two variables from the stock market. So the first variable is the EUROSTOXX stock market index. Yeah. The second one is the volatility index on the EUROSTOXX. So that's basically the so-called VSTOXX index. Yeah. So the volatility index basically, for instance, measures the expectations of future volatility in the stock market, not the actual volatility, but it measures the expectations. And those expectations basically are extracted from, well, the option pricing, like Merton option pricing models. Okay? And as exogenous variables, basically, we have two principal components that are extracted from fixed for floating euro interest rate swaps for different maturities. Yeah. So what I did here basically is principal component analysis, basically by using different maturities, by extracting only the first two principal components, which are called the level and the slope. Now, why interest rate swaps? Basically because the literature suggests that the interest rate swaps basically they approximate the so-called risk-free interest rate, although in practice everybody knows that such a thing does not exist. Yeah, but at least we can approximate this with these two variables. Yeah. Okay, so fixed for floating means basically that, for instance, I pay you basically fixed interest rate, let's say 3% per year, basically, and you pay to me the floating interest rates, for instance, the EURIBOR interest rate plus 2.5 interest rate. Yeah, so basically, in a way, if you have like two parties, you know, to the interest rate swap contract, basically, so the objective of these derivatives basically is to hedge against the interest rate risk. Well, it depends basically on what for you are using, you know, your debt. Yeah? Okay, so now if you have a glance now at variation over time in banking sector and sovereign credit default swap spread. Yeah, so these spreads are measured in basis points. For instance, 200 means is 2%. Yeah, in a way that this is the risk premium that you have to pay for having your debt investment insured. Yeah, for instance. Yeah. So as you can see, basically, there was a decreasing pattern, basically, in the two spreads before the subprime mortgage crisis, so essentially before July 2007, yeah. So that was, as you will see later on, that will be, you know, the first regime or the low volatility regime in the credit default swap market, yeah. And then the intermediate credit default swap regime starts with the reported losses, huge losses in the subprime mortgage market by the worldwide HSBC bank. Yeah? Okay, and then it comes basically September 2008 when the Lehman Brothers Bank collapsed. Yeah, and this was followed by massive interventions, basically in the by the euro area governments in the banking sector. So because of this reason, as you can see, there's a temporary divergence between the two spreads, between the banking sector credit default swap and the sovereign credit default swap. So this is because the credit risk was transferred from the banking sector to the government, but only temporarily. Now, why? Because, as you well know, basically banks invest in government securities, yeah, in many countries. Nowadays, they would prefer to buy government securities than to lend, you know, so there's a high proportion of their assets that is invested in government securities. And when the government basically has very weak finances, basically, so the credit default swap spread they increase, basically, and there is again movement in unison between the two variables. Okay, so now I can also already provide my estimation results, basically. So what you see here is basically the smooth probability of the low volatility state. This is in red, and in basically in this gray polygon, basically gray polygon denotes the situation when the smooth probability is greater than 0.5. So basically this means that there's a greater probability of, you know, of low volatility regime. And this was precisely until the mid of 2007, until July of 2007, yeah? When basically the market of the credit default swaps was quite smooth, okay? Now we have regime number 2. Basically, in regime number 2, again, regime number 2, which is the intermediate volatility regime, started essentially in July 2007, basically, and lasted until, August, September of 2008, yeah? It recurred in, in 2009 and then in 2010. So basically, I should say that the history of the credit default swap market was essentially, well, at least this bit of history was dominated by the intermediate volatility regime. And what about now high volatility regime? So high volatility regime we have basically in periods that coincide with the collapse of the Lehman Brothers and many other banks, and government interventions in the banking sector. And also some other bits, basically, that also coincide essentially with the sovereign debt crisis in the Eurozone. Remember, the data are on the Eurozone, okay? And basically, if you now associate basically these probabilities of high volatility states, so as you can see, that happened in periods when credit default swap spread peaked. Okay. Now, some more interesting results, they relate to the generalized impulse response function. So first of all, basically, we can see what happens when there is a shock in the banking sector credit default swap spread. Okay. So we have here 4 variables here. So in order to address the hypothesis number 1, yeah, we have to ask, what is the response of the sovereign credit default swap spread to the banking sector credit default swap spread? So basically, now as you can see here, there are 3 regimes. So each column corresponds to one regime, yeah? Regime number 1, low volatility regime. Regime number 2, intermediate volatility regime, and regime number 3, high volatility regime. Yeah. Now, well, first of all, basically, as you can see here, because on the vertical scale there are positive numbers, so the effect of the banking sector credit default swap spread on the sovereign credit default swap spread was positive, and also increasing with the regime. So the periods after the shock basically indicates, you know, the evolution of the response. But it is flat. Why? Well, because the impulse response function here are cumulative, basically, so they accumulate all the effects. Now, what does that mean? So basically, this means that when there is an initial effect in the beginning, when there is an initial shock, let's say in the banking credit default swap spread, so there is only, you know, is one of change in the level of sovereign credit default swap spread, and then it remains flat. The response remains flat. So basically, it stabilizes in the long run. There is short-run effect, but it stabilizes in the long run. Okay? So this supports basically hypothesis number 1. Okay? Now what about the shock to sovereign credit default swap market? So basically, in order to address hypothesis number 2, we have to ask, what is the response of the banking sector credit default swap spread? So again, in line of our hypothesis, there is a positive response. Yeah? So, so the banks respond positively, and this response increases with volatility. The higher volatility is in the market, the more responsive is basically the credit default swap spread. I forgot to mention basically that the bands, the blue bands around the black response are basically 95% confidence band. So basically, roughly there is 95% probability that the estimated response is within those bands. Okay? So may I conclude now? So basically what we find here, what we do here, first we identify 3 regimes in the market according to the residual volatility in the credit default swap spread. Okay? Now, second, basically we estimate the generalized impulse response functions, and these functions basically provide support to our formulated hypothesis number 1, hypothesis number 2. So hypothesis number 1 basically implies the positive causality from the government to the banking sector, and hypothesis number 2 basically formulates the feedback effect. And according to our results, the 2 hypotheses are valid. But in addition of those hypotheses, basically we also see that basically in more volatile regime, there is basically more evidence of the so-called contagion. Yeah, why? May I ask why? Well, just because basically in the period studied, basically naked investments in the credit default swap market were also allowed. Yeah, and naked investments are also those investments that tend to destabilize the market. Yeah. So essentially, basically, the credit default swap spread, they respond to basically credit rating by the rating agencies such as Moody, Fitch, Standard & Poor's. But in addition, because basically the naked investments are allowed, so the spikes that you observe in the behavior of credit default swap spread, basically they account for volatile behavior and possibly herding behavior of investors in the market. Okay? So this is about, very shortly, about my research. I provide only a subset of the results. Now, like I said, I have to justify my presence here, why I'm here. Yeah? So basically, so I collaborate with Dr. Angel. Yeah? He's also a researcher here. He's also associate professor, soon be a full professor. And as he mentioned, we use meta-heuristics to constrain mean variance portfolio optimization. Yeah? So basically, we have a big project in mind, and basically mean variance portfolio optimization, basically it's only a part, of that project. Yeah? So we are possibly overly ambitious in this sense. Now, what is constraint? First of all, what is the mean variance portfolio? So basically, well, that is the portfolio, basically. So you have your investment, your wealth invested, in many assets, basically. So by investing in those assets, who that tend to imperfectly commune, so you can minimize your risk of investment. So the risk of investment is on the horizontal axis by maximizing also the return. Yeah. So basically, this frontier, this red curve, is called the efficient frontier because all of the portfolios to the right of this frontier are not efficient. They are feasible, but they are not efficient. Now, the portfolios that are to the left of this frontier, yeah, will be more efficient, but they are not, unfortunately, feasible. Okay. So basically, okay, let me get back. The problem here is that if you have many assets, yeah, so you typically do not invest your wealth in all those assets, but you only invest to a subset of those assets. Now, what does it mean? So this means that the theory behind the Markov-switching portfolio theory that was developed, in the early 50s, basically is theoretically elegant, but has very little practical appeal. Yeah. So in order to cure this shortage, basically we propose an algorithm basically that helps solve a realistic portfolio optimization problem. Okay. So now, what is unconstrained? Well, unconstrained is that when you refers to the situation when your investment is not constrained by any other restrictions except for the non-negativity constraints. Basically means that if you have a portfolio of assets, so you allocate weights on investment in that portfolio to different assets. So let's say if I have two stocks, I have a Google and I have Microsoft. So I, for instance, invest 40% of my asset in Google and I invest 60% of my wealth in Microsoft. Yeah. So basically, portfolio optimization refers to optimal allocation of your investment weight. Okay. So unconstrained is basically in quotes, meaning that you still have some small constraints, but some reasonable theoretical constraints, such as basically all weights must add up to 1. The weights cannot be negative, so short selling is not allowed. Weights cannot be greater than 1, so this means that leverage long positions are not allowed either. Yeah. Okay. Now, if you have unconstrained portfolio selection that is theoretically, albeit not practically appealing here, so for the simplest version, so you can find closed form solution here. For slightly more complicated version, you can use like traditional numerical methods such as complete enumeration or differential calculus. Yeah. But now, if you add additional constraints such as cardinality constraints, it's like, I wouldn't invest, my wealth in more than 10 assets because it gets overly complicated. Yeah. Pre-assignments, we'll get to that point later on. So this basically means that I would prefer, to invest no matter what to like Google. Yeah. And the quantity constraints. So if I invest Google, I wouldn't invest less than like 20%. I wouldn't invest more than 40% of my wealth. Yeah. And with these constraints, basically, the problem becomes the so-called non-deterministic polynomial time complete, which means basically that there is no known deterministic algorithm that can find an exact solution within polynomial time. Okay. So now the question is why unconstrained portfolio selection problem has a limited practical appeal. No, this is because of different reasons. Because my desire, if I'm an investor, so my desire to diversify may be limited. Yeah. I just want to keep my wealth, in a specific number, few assets. Yeah. Also, related issues that the administration of large portfolios can be, quite cumbersome, could be quite expensive if I just invest one promille, my wealth in a specific asset, for instance. Yeah. And also there is evidence that basically diversification can be achieved by investing in fewer assets, basically than suggested by the literature. And also there might be the case that basically investors might be sentimental about specific assets. So for instance, my wife may be sentimental about basically L'Oreal. Angel may be sentimental about the Supercell stocks. So Supercell is a Finnish company that sells mobile games. That's quite appealing for Angel. Yeah? And when these realistic situations are accounted for by the model, so the efficient mean variance frontier can become discontinuous for certain values of required return. So we now get back to our picture, basically. So this situation is described by the left-hand side graph, where you can basically spot some discontinuities. Now, what does that mean? So that means basically that if you are an investor, basically, so you should not basically consider those portfolios that basically can be described by this range of returns. Why? Because simply there will be better portfolios with basically possibly higher return and definitely lower risk. Okay? Okay, so basically when we have additional constraints, yeah, so we run into so-called numerical and statistical problems, and therefore the traditional numerical methods may be simply useless in these kinds of situations. Yeah. So well, that's why basically we propose meta-heuristic methods. Yeah. So basically, the advantage of these methods is that they combine basically the advantages of traditional optimization methods, such as basically differential calculus or complete enumeration, yeah, and stochastic methods, radically stochastic methods, such as Monte Carlo CH. Yeah? So, like traditional methods, they try to find the optimal solution. Yeah? So that's why it's still still remains a portfolio optimization method, because we are looking for optimal solution. But unlike traditional methods, basically, like I mentioned, they incorporate stochastic elements, basically, that make these methods less likely to end up in local optimum. Yeah? So it could be the situation, yeah, with traditional numerical methods where you cannot see the woods through the trees. Yeah. Now, meta-heuristic in a way basically they help you see the woods through the trees, if you like. Yeah. And they are less restrictive than traditional methods and can be tailored to solve a particular problem. Basically, again, if I want to invest basically my wealth into Google, Supercell, L'Oreal, so I can define those assets. So they are called pre-assigned assets. I can define basically lower and upper bounds, for cardinality constraints. So what is the fewest number of assets to invest, and what is the largest number of assets? And also I can define basically the weights on those assets, that I allocate. Okay, so basically here I have basically a part of the algorithm, the so-called algorithm for realistic portfolio optimization that was designed by Angel, basically. So basically what we have here is, we have different stages, This algorithm loops over basically potential solutions, basically. So we start from, the initial solution. So the initial solution basically provides you an initial actual portfolio of assets based on a maximum return, no matter risk. No matter what risk it is, yeah? So basically, if we have basically return of Google higher than the return of L'Oreal, basically, so the local solution implies that we will basically invest a high proportion of our assets in the Google than in L'Oreal. So that's what the initial solution means, basically. And then basically, the algorithm asks, is this solution the optimal one, and whether we can or cannot find basically better solutions basically. So we take those assets that provide basically the minimum return, in our existing portfolio, and then we ask whether assets that we left out of the portfolio can be better candidates to our portfolio in order to basically minimize the risk and maximize the return. Yeah? So basically we have different stages. We have the initial stage, we have the local CH that helps you fine-tune your portfolio, and we have basically the dramatic stage basically that perturbates considerably your portfolio of assets basically. Okay? So again, if you have basically, if you have L'Oreal and you have Google or you have Supercell basically, so the algorithm, the algorithm for realistic portfolio optimization helps you basically to combine those two assets, in an optimal way. But for that purpose, basically, you have to make sure that if your clients are investors, that all basically restrictions provided by investors are satisfied, and the algorithm accounts, for these aspects. So basically we have the initial solution that I mentioned before. Then at each iteration, the previous iteration solution is destroyed and reconstructed using the so-called efficient, sensible efficiency indexes here, such as the Sharpe ratio or the relation between the return and risk on individual asset. Yeah. So basically, the higher is the Sharpe ratio, basically, so the better off you are as an investor in that asset. Yeah. Then another efficiency index is the ratio of the individual asset return to the average covariance of that return with all other returns. And the third efficiency ratio would be, for instance, the sum of two returns to the covariance, basically, between those returns. So basically, if we have some assets, that are efficient outside the portfolio, so basically, the purpose of this algorithm is to find those assets and to replace less efficient assets in the portfolio by more efficient assets, from outside of the portfolio. Okay, until basically the algorithm converges to the optimal solution. Okay. So that's about it, basically, and thank you very much for listening. Now, are there any questions you would like to ask? Any questions?
About this portfolio optimization,
Yes.
is there any other work done so far that could be related, or just like traditional methods that methodologies that have never been applied to this? Or very
They have been applied, yeah, basically, yeah, so basically they have been applied, yeah. But we noticed, myself, that those models where they were applied to were quite simple, although basically their purpose was to solve complicated problems, but quite simple in a way that, for instance, the quantity constraints were placed between 1% and 100%, which is which provides you a very broad range, basically. So it doesn't really make much sense. Yeah. So our intuition is that such an algorithm, provided by competitors, may not be very efficient, for more complicated problems. Yeah. And so the purpose here is basically to provide, with a better algorithm in this sense. Yeah. Any other comments, questions, suggestions?
Yeah, I guess that at this moment, this algorithm that you are proposing is just the first step. You are just working with that.
Yes, we are working that, yeah. Our programmers are working, yeah?
Oh.
Are they, Angel? Yeah, so.
Because my question was about how to manage about this tuning, about, just considering the destroyer and then reconstruct a previous iteration. Do you have some idea about?
Yeah, so, well, the difference between them is that fine-tuning typically involves basically discarding one asset and replacing this by another one, or simply adding another asset that basically complies with certain criteria. Now, the perturbation stage basically refers basically to destroying, you know, a subset of assets. Let's say if we have portfolio of assets, let's say of 20, so basically you get rid of 5 assets and you replace by another 5 assets, and that dramatically changes basically the structure of the portfolio. So that's why it's called, you know, perturbation. You know, it's like Big Bang, you know. So.
But in this kind of sensitivity analysis,
Yes.
you must take care of not going too far away of the optimal solution.
Yes, well, Angel wants to intervene.
Right now, that one is quite tricky, in fact. I mean, he only showed the general framework, which is the local search developed by Renatas. But the details of there are several methods there: the local search, the generating initial solution, and the perturbation. But they are quite tricky, in fact. We didn't show them here, but the programmers know. These are the people who are programming the algorithm at this moment. They know that they are quite tricky. And the main ideas, maybe, I can explain very fast way, are that, for instance, when you ask about the local search, I guess, so when you basically take your solution, this is a base solution, so you destroy the solution partially using like I said, scheme with randomization, okay, trying to extract these assets which are not quite efficient, right? And then you reconstruct that, but the reconstruction process is very subtle, because you have to do that one piece one by one. I mean, you start adding one element from outside the current solution, and then you recompute everything, because you have to make sure that you are not exceeding the 100%. Yeah. So as you remember, there are these levels, these percentages you assign to each asset. You have to reset this asset to these levels to the minimum, and then you have to sort again all the elements, and then
the previous weight were not anymore okay.
That's correct. And then reset all these levels, okay, to a new value. And then we decided to go for 3 different types of local search. This is one that you can add one element. It's more or less like you remember in multiple regression, you use this background. Forwarding
forward and backward.
Yes, so more or less it's similar idea. You have different ways to do this. One way to go is to add one element one by one. Then you add the best element outside there. You do an intensive search there. You have also the possibility of deleting one element from the current solution, and you have also the possibility of doing a very fast swap. Okay, so if the local search are different, because when you do the swap, the number of combinations is too high. So when we do this, we decided to keep the current level. We don't reset the current level. But when we add the new element, or when we delete the new element, we have to reset the element. So it's quite tricky, because you have to make sure that all the constraints are satisfied. But I think we will start to have results today.
Yeah.
So.
Right. Thank you very much.
Any other comments, queries?
I have one final question for you. Do you think these ideas about what we are working now on the portfolio optimization, realistic portfolio optimization, which is the difference with regards to previous work, realistic? Do you think they can be also applied similar algorithms to the first part of your presentation?
Absolutely, yeah. Basically, if we take, for instance, well, either basically government sector, but possibly, better idea would be, to take banking sector and ask, what would be, the optimal mixture of assets, in the balance sheet of a bank, given all sorts of constraints, such as, the constraints imposed, by the Basel III Act, on the capital adequacy of the banking sector. Yeah. Now, also, basically, remember that we have, regulators in individual countries, and the banks, they have to comply, to their requirements, So, I would say that basically the banking sector, you would find many more constraints that we have now in this realistic portfolio optimization. Yeah. So basically, in a way, yes, basically, but then it has to be, well, we need to invest possibly more time and work, basically, to well, take into account all those constraints. Yeah.
Any other question? So let's thank the speaker.
Thank you very much. Thanks for coming.